Okay. So Tyler, shares of Enphase, like SolarEdge, a lot of other companies in the solar electronics manufacturing business have come crashing down recently because of a shift in the demand cycle. Demand has really weakened, and we know this is a really cyclical industry, and it seems like we're approaching the bottom part of the cycle. Who knows how long that's going to last, whether it's a few quarters or longer before the cycle starts to turn again. We had a viewer recently who posted a comment with a concern about Enphase. I think now's a good time to address. And that's something that could be certainly not a fatal flaw for the business, but a fatal flaw for investor per share returns. And you've done a little bit of research and we're going to talk through it. You ready to have this conversation?
You set the financial statement bloodhound to go digging, so I can tell you what I found.
All right. I'm looking forward to this conversation. I'm Jason Hall. This is The Smattering. And this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, please go to our special link, fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Please check out that link after the video. Okay, Tyler, I'm going to share the screen. This is operating cash flow. So I think this is a useful metric for looking at these sorts of businesses. And this is over the past 5 years. And we have two lines. We have the purple line here, which is operating cash flow. So we're up to $1 million over the past 4 quarters. And then we have operating cash flow per share, which we see has actually followed a similar trajectory, which is really good. This is a cash cow business. It's pumping out lots of money. But our friend that made the comment is worried about this. And this is stock-based compensation. And you can see that number has grown at a very high rate as well. Our viewer is concerned that stock-based compensation is going to continue to destroy value, wipe out returns for investors as the company is gradually peeled apart and a portion of it is awarded to employees.
The theory behind that is very much in line with a lot of concerns I have with many other companies out there today. I think stock-based compensation is one of the more perverse things happening in Wall Street.
Egregious and rampant, I believe, are two words that I've heard you use in the past.
Yes, and let me bias this a little bit and say, compared to some of the other places that I have looked and seen egregious stock-based compensation policies, Enphase's doesn't quite hit that level. And so you showed some numbers. So, and 2019 was a really good time for us to really start to do the comparison for Enphase, because in 2019 it was where it signed that transformative deal to acquire all of the microinverter business from SunPower and become SunPower's sole provider of microinverters for SunPower's panels back when SunPower actually made panels.
And at the time, that business has been spun off as a separate company.
That's 6 businesses ago.
But the point is, like, the underlying part of that business, providing the panel level electronics and the inverters and the microinverters specifically for distributed solar, which is that's Enphase's business. That was also at SolarEdge, and like I said, it's a different company now, but that's still the same thing. That's like still the core of what those panels are used for.
Yes.
But this is what it did, right? This is what it did to. This is what the stock price did. Huge run up. Look at it from a percentage base, right? The stock was up 7,000% at some point. But again, looking at that operating cash flow metric, that's the result. When your cash flow goes up 56-fold, things are good.
Yeah, it was a transformative move. So I went back in 2019, and in 2019, Enphase had about $624 million in sales, about $10 million in operating income, and $20 million in stock-based compensation. So actually, it was handing out more stock than it brought in, even in operating income. Over the 5 years, it's ballooned to $2.7 billion in sales over the past 12 months. I may have missed the third quarter, depending. I can't remember when I actually pulled these numbers. So if this is off by a quarter, I apologize. But trailing 12 month, I had $2.7 billion in sales, about 618 in operating income, and then 221 million in stock-based compensation. So over 5 years, stock-based comp increased 10x, but operating income grew, like you said, about 56 times. I know the numbers are maybe a little different from what you showed, from what I pulled, because I had about 60, a little bit more than 60 times. So if I were to base,
depending on the tool that you're using to pull this data, you might get a little bit of difference in the numbers, but directionally, they're essentially the same. Right.
But the larger issue, I guess the wider thing is that cash flow per share and total and op income were growing at a rate faster than stock-based compensation was going out the door. So it wasn't It's not great to see $221 million going out over the past 12 months in terms of stock-based compensation. It's not the most egregious, but this is where I think you and I have had conversations about this offline, and something we should bring to the fore is there's a difference between performance-based stock-based compensation and what, in my opinion, are executive entitlement programs.
Right.
What I mean by this is that regardless of how the business performs, somehow management always seems to hit the upper ends of their bonus targets almost every time, like clockwork. And they get glowing reviews from the board, and everyone is getting great things. I have to give this example because it's the one that always comes to mind to me. Zillow. A couple of years, I think it was like last year or 2 years ago, they had this big push into what they called iBuying, which was basically like trying to be a digital marketplace for homes. And they ended up destroying a ton of value in the business going after this. They scaled up, they took on a lot of debt, and then they basically unwound it and had to sell a bunch of houses at a loss to fix what they had done. And the resulting, all of that, basically, like, they had to nix an entire business that they were saying was the future of their business. And yet in the next year, somehow stock-based compensation went up. Like, how do you have a spectacular failure like that and still get higher reward for your executives? This is, like I said, this is my example of an egregious stock-based compensation issue. And so what I want to see with Enphase is, look, things have started to go sideways. The business is not quite as strong as it was. Management at Enphase Technologies, their closest peer, I guess you could say, have both been echoing the same thing of, we're seeing a slowdown. As second mortgages and the rates on those are up, so it's harder to spend money on residential solar right now. It's just not as lucrative of a market, especially overseas in places like Europe. Admitted that Europe is considerably weaker than America right now. If the business is weaker and we see a decline in performance of the business, but somehow we still see increasing amounts of stock-based compensation and management somehow still hitting the upper echelons of their targets, just like clockwork, that to me is a sign
That's a
of
concern.
That's an executive entitlement program, and that should be a greater concern for investors.
I'm going to second that, because again, I think the key is, and I'm going to share this on the screen again, because I think, and again, the numbers, depending on Tyler's source or the source that I'm using, maybe just a little bit different. But again, this is going back to the beginning of 2019. Stock-based compensation in dollars is up 19-fold. That is a substantial increase. The price of the stock has gone up a tremendous amount over that period. So that's not even on here. So if I put that on here, there you go. So those are tracking together, which that makes sense. But this is the key. Free cash flow per share has grown well over double what we've seen stock-based compensation increase. So it's okay for management to get compensated well when the business is doing well. And that's what has happened, right? That is exactly what has happened. So what we're going to learn, to Tyler's point, is as we go through this down part of the cycle and the business has to readjust, we're going to find out how good management is at making sure the business is right-sized for that environment, can remain profitable, or at least minimize losses during the down part of the cycle, and make sure the business is still strong. This is the most important part. Other videos we've done, we did a video recently talking about First Solar. This is maybe the most important thing its management has done, is made sure the business was still strong when the cycle turns, when it turns back good, so they can quickly reaccelerate and make the most when when the sun is shining, to use a really bad dad pun here. And this is where management's going to really earn its money at Enphase, is making sure the business is able to do the exact same thing when the market does turn, that they're able to reaccelerate growth to the next higher high in demand, like if we're always going to see with solar. The next part of the cycle is going to be higher. It's going to be a higher mountain. So it's all about making sure the business is ready for that.